Everyone's heard about the tough situation banks are in these days. From the struggling economy to shifting interest rates to increased regulations to new client behavior, the game has clearly changed. All of these affect how we go to market, how we balance client needs and shareholder expectations, and how we make money. Despite these challenges, the country needs banks to be financially healthy. Excellence is required. Today, more than ever, we need to efficiently implement our three guiding principles, that of one team, client first, and profitable growth. So let's first talk about profitable growth and how we make money in this new environment. Generally speaking, banks have typically made money in a couple of ways: fee income and net interest income. Fee income comes from things like debit and credit card interchange, trust and investment, loan origination, merger and acquisition work, loan underwriting, and mortgage servicing. There are also fees associated with client behavior, like overdraft fees and late payments. Net interest income is the money banks make from the spreads on loans and deposits. Basically, we need deposits to make loans, and the interest we charge on loans, less the interest we pay on the deposit, equals our net interest income. And of course, it's always been important to manage costs so that we're preserving the bottom line. The financial crisis that began in 2008 changed things. As the situation worsened, the government intervened to stabilize the financial system. Regulation increased. This put enormous pressure on our fee income as more and more fees were reduced or eliminated. For retail banks, this meant a shortfall in the tens of billions of dollars. Net interest income also came under pressure. Loan demand dropped off sharply. Mortgage production volume is roughly half of what it was in 2006. Higher yield loan balances are running off and being replaced with lower yields. It's a double hit. Simply put, we're producing fewer units given weak demand, and the units we do produce are worth less. Ouch. In the past, collateral was worth more, yields were higher, investment activity was strong, and the bank had solid revenue streams. Now, yields are lower, regulations are restrictive, consumers are holding on to cash, and fees are way down. All of this paints a pretty bleak picture. The big question is, what do we do? As a team, how do we become better and more efficient? Leveraging loyalty to meet more of our clients' needs. Well, we've already made some good progress. Suntrust has worked hard for the past few years to build client loyalty, even in the face of severe economic turbulence. In fact, we're the top bank in loyalty thanks to the hard work of our incredible teammates. But despite our efforts, we can do better. When clients become loyal, which means they have an emotional connection to the bank that goes beyond functional transactions, there's an increase in net contribution margin. If we look at a chart that compares clients to the number of needs met, you can see that the more needs we meet, the more the dollars go up. For clients where we serve more than 2 needs, attrition rates drop to less than 5%. What's more, meeting more needs exponentially raises the lifetime value of a client relationship. And when you add in teammate engagement, we see an even more dramatic increase in the financial growth. Suntrust's approach is to build one team around the client. We're a relationship bank. But if a client has only one need met, it's hard to fund a team. As more needs are met, we break even at some point. The more needs we meet, the happier the client and the more money we make. So here's the story. With declining revenue opportunities, we're finding new ways to increase revenue by leveraging our loyal following and meeting more client needs. In other words, getting our loyal clients to make us their primary bank. Managing costs. The situation we face as a bank is not unique to Suntrust. Our peers are in the same boat, and yet when it comes to efficiency and productivity, most of them are performing better. Most of them have efficiency ratios, meaning the cost of generating $1 of revenue, that are much better than us. So there's more we can do. Like any business, we need to focus on profitable growth by managing cost as well as generating revenue. Channels. Our branches are the best place for our clients needing an interaction rather than a transaction. And together with folks like client advisors and relationship managers, our branch teammates are in the perfect place to build relationships that lead to meeting more clients' needs. But as we manage costs better, we are looking for ways to deliver value through lower cost channels like ATMs, online and mobile solutions. Think about this. In the online space, we sell as many accounts as 300 branches, which is equal to an entire division. Our ATM transactions are equivalent to that which can be done in 800 branches. Stoli handles more transactions than 80 branches every day. It is rather remarkable. And today, mobile banking sees 650,000 transactions a day and is expected to be at almost 1 million transactions per day by the end of this year. The great news is that while we think there will always be a place for the branch, our clients want more self-service channels, which have the advantage of improving loyalty and lowering costs. Support functions. We also need to find ways to deliver support more efficiently. Remember our guiding principles, that of one team, client first, and profitable growth. It's going to require everyone pulling together to make it work. It's about working smarter, not just harder, but it's worth it. Because as each support function increases efficiency and productivity, our corporate financial performance improves. That work is going on right now, and we're all a part of it. Our challenge, one that we are meeting head on, is to get leaner and more efficient as we continue to weather the economic environment. We're looking at our revenue opportunities, our cost structure, and ways to leverage loyalty to meet more needs. Increasing the number of needs met, focusing on loyalty and teammate engagement while improving our efficiency is something all of us can be a part of. If you take each piece of the pie and reduce it by a percentage, look what that does to our efficiency ratio. Get ready and be a part over the coming weeks and months. It's likely that you will be involved in some of the changes to improve our performance. Whether it is rethinking costs like wireless devices or travel, or rethinking how teams are structured, every teammate can be a part of the solution. Share ideas with your manager about how you think we can improve our performance. The good news is that while we can't control the external environment, we are taking control of how we operate, and together we will lead our teammates, clients, and communities toward a better financial future. We can do this. One team, client first, and profitable growth.